we came to the conclusion that it makes sense to solve the biggest problem for the traditional investor regarding Bitcoin, which is the high volatility, by combining these two somewhat similar asset classes in one portfolio.
Welcome to the Gold Exchange Podcast, where we untangle market and policy complexity using timeless economic principles. For show notes and archives, go to goldexchangepodcast.com.
Welcome back to the Gold Exchange Podcast. My name is Ben Nadelstein of Monetary Metals. I am joined today by Mark Valek, partner at Incrementum, and in my opinion, the world's foremost expert on combining gold and Bitcoin into a portfolio. We're going to learn a lot about that today. Mark, welcome to the show.
Hey, Ben. Thanks for having me on.
Mark, I'm pretty excited. As you can obviously see, I'm a pretty young guy. And so Bitcoin is kind of in the news, obviously. For young people, that's kind of their asset of choice for a lot of them. Gold is kind of seen as more boomer. Older people own gold. So you're one of the first people to pioneer owning both gold and Bitcoin in the same portfolio. So first off, how did you come to this idea, and where did you start your investing journey before you heard of both gold and Bitcoin?
Right. Well, I started off as a fund manager in Vienna, and I had actually, even though I was educated in Vienna, no clue about the Austrian School of Economics, unfortunately. When I finished my traditional education, and I learned that shortly after, actually, I started as fund manager, and I was really fascinated by that because I realized that actually traditionally people don't really look at the monetary system when they do investing projects, or classical investors just look at cash flow, dividend cash flow models and so on, and never think about the monetary system so much. But I was of the opinion that it probably is very fundamental also to investing, and I thought there is actually no real investment philosophy, or I didn't know of any investors who actually really took into account the monetary system, and that's what motivated myself and also my partner Ronnie Stöfferle to start up our own boutique, Incrementum, 11 years ago already, where we actually focus on creating investment strategies which do take into account the monetary system. That's a little bit my background, and that's what I do very passionately today.
So, Mark, you've described yourself not only as an Austrian in terms of your, physical origin, but also an Austrian in terms of your economic philosophy. So, for someone who has no idea other than the country of Austria, what is the Austrian School of Economics? And if you're an investor today, why should you care about the Austrian school versus, maybe Chicago school or the other options when learning about economics?
The Austrian School of Economics is a tradition which obviously had its origin in Vienna, Austria, somewhat almost 150 years ago, founded by Karl Menger. I think some of the theses of Austrian economics are still around also in the classical mainstream economic streams today. But generally it has been pretty much forgotten, or has survived as a little bit of exotic offspring, or own school of thought. I think the most important difference between mainstream economics, which typically would include Chicago School, as you mentioned, or especially Keynesian economics, which is probably the most widely spread school of thought in the mainstream, is that it puts really the individual first. So it really thinks about human action as the basis of economics, because we are humans, obviously, and how humans act, that really should determine the thought process when it comes to economics, right? So when it comes to investing, again, I think one of the biggest advantages is when one has an idea about Austrian economics is making oneself conscious how this this monetary system actually works. Mainstream economics typically take for granted that we have a central bank, take for granted that we have a monetary monopoly, and it has been like that for many centuries, in fact. But it wouldn't actually have to be like that. And also historically, if one looks at monetary history, typically money actually is a social product of a social consens, right? So society typically decides what good is the best money, and then typically the state comes in and monopolizes the money and corrupts money and uses money for its interest by inflating money supply, and this has all kind of effects also on investing. And I think this is one of the main practical advantages of having an idea about the Austrian school. But then also I think one needs to be aware of the limits when applying Austrian school to investing. I think that can be one part of the toolbox, but it's not like a panacea for everything. Just because you know Austrian school, you won't automatically become a great investor. So what we did 10 years ago, I think, was we wrote a book which is called Austrian School for Investors. In investing between inflation and deflation, which already I think lays out a little bit. These two factors can have quite significant impact on investment portfolios. And we try to lay out the advantages, the potential advantages of Austrian school knowledge when it comes to investing, but also its limitations. So perhaps an interesting read for whom wants to know more about that.
We'll absolutely have that in the description of the video. So, Mark, you and your partner, Ronnie, recently joined the board of Monetary Metals. So what got you interested in the company Monetary Metals, and what initially got you interested really in bridging the gap between traditional finance, which most people are aware of, versus things like emerging monetary alternatives, whether that's gold or even Bitcoin?
Well, in fact, I think it has been almost 15 years ago when I met Keith Weiner, the founder of Monetary Metals, in a course about Austrian economics. So I know that he's very into Austrian economics as well. So there was this personal connection, but also then when the company was founded, I was looking at what you guys are doing and found it very interesting. And I think it's quite a good match because it fits into my mindset very well, and so I hope I can be somewhat helpful in that role, and looking forward to talking to you in this position.
So, Mark, one of the things that you're unique for discussing and thinking about in making portfolios is this idea of a synthesis between physical assets like gold and digital assets like Bitcoin, and constructing what you often call a sound money portfolio. So you've got gold, which is usually considered an alternative form of money, and now you've got Bitcoin, which is kind of this emerging cryptocurrency. So first of all, you're one of the first people to try this as a synthesis. So have you seen the performance of the strategy working so far? Obviously, Bitcoin has hit an all-time high. Gold as well this year, hitting all-time highs. So clearly both of these assets have been shining, but talk about actually combining them together. What have you seen in terms of performance?
Right. So, I mean, generally in my experience, when it comes to Bitcoin, it's a pretty emotionally discussed asset, especially also perhaps among the gold space. So you have people that love it, you have people that hate it, but you also have, in my experience, a growing group in between, which are more pragmatic, especially when it comes to their portfolio investments. And I think one has to distinguish the discussion a little bit about Bitcoin as potential monetary system and Bitcoin as an investment or as part of your investment portfolio. And I think one can have discussion which could be the better money. Bitcoin or gold, for instance, and that's where actually I focus more on, what to do as investor, how to potentially implement Bitcoin into a portfolio. And since, I mean, Ron and I found Bitcoin pretty early, as we write the In Gold We Trust report every year, which is, as you know, an extensive coverage and holistic report, not only about gold, but about global monetary system. The recent years also including geopolitics more since it has become more important. And with by doing the research in this space, we actually found Bitcoin pretty early on, and also from an economical side, I'd say understood it pretty rapidly. Not so much perhaps the technical ins and outs, but we knew what the idea, the general idea behind Bitcoin was. But it was so small actually back then that it was even difficult to imagine that it had any chance to being able to pull that off, right? And still, I mean, Bitcoin has come a long way, especially in terms of market cap, obviously, and in terms of adaptation. But we're still very far away from really having any kind of official monetary role with Bitcoin, right? But if one comes to the conclusion that there is a chance that Bitcoin may just stick around, then there is a chance that actually digitalized assets will be established, and I think by now chances are that it's pretty high that it's not going away, right? I think as soon as one comes to that conclusion, and one thinks about implementing a part of Bitcoin, for that matter, into one's portfolio, it makes sense to think about how to do that best. And we thought it made probably sense to combine it with gold investments. There are similarities between Bitcoin and gold, but there are also fundamental differences. So there are advantages and disadvantages on both sides, in my opinion. And we came to the conclusion that it makes sense to solve the biggest problem for the traditional investor regarding Bitcoin, which is the high volatility, by combining these two somewhat similar asset classes in one portfolio in a way that manages the volatility, so makes it more, I'd say, gives the investor better usability, if you want to put it that way, as a building block in the portfolio. And by that, and that's the big advantage, taking actually advantage of Bitcoin's high volatility. So what we do specifically is we combine, we've got two strategies, but in the more conservative strategy, we combine 25% Bitcoin allocation, strategic Bitcoin allocation, with 75% gold allocation. And with this kind of portfolio combination, you get a building block which is similar to an equity mandate, perhaps to emerging markets, a dynamic equity mandate, I'd say. And this kind of volatility, I think generally traditional investors are better able to handle, right? That's, as I said, one big advantage. And by rebalancing these assets, you can actually take advantage, as I said, from the volatility, because you systematically take profits into strengths. Whenever Bitcoin rises to a certain level, we take profits, go back to the strategic allocation. And when it goes too far below our strategic allocation, we take some of the gold and go back to rebalance into Bitcoin. And by that, we are always anti-cyclically, even though we don't know where there is a top, where there is a bottom, but we will systematically buy low and sell high.
I think this strategy is really smart. And one of the things that I like about you and what you guys do is you say, listen, we can have these, more theoretical debates about the monetary system and gold and Bitcoin. Would there be deflation on this system or that system? And those are fun, and maybe we could have a beer and talk about those things. But if you just strip away the names of these assets, right? You don't write gold on it, you don't write Bitcoin, you don't write bonds, you don't write stocks, you don't write emerging markets. You just look at the returns and the volatility and the numbers. Then a pragmatic view approaches, which says, hey, this asset is volatile or this asset is less volatile and the returns on this asset look like this. And what you can do is come up with strategies to pair those for certain desired investment outcomes. For example, okay, this has a lot of volatility, but high return optionality. This one has lower return optionality, but lower volatility. And when you pair those, you can come up with interesting strategies. So can you tell us quickly about harnessing Bitcoin's volatility? Because a lot of people say, I don't want to invest in Bitcoin. It is so volatile. It can drop 30% in one day, and then a week later, it's up like 500%. So why would I ever want to invest in that? If I'm a grandma, I can't take 30% drawdowns. Come on, Mark, that's ridiculous. But you've said, wait a minute, let's use that volatility for our advantage. One of the things you come up with is options writing. Maybe tell us a bit about harnessing Bitcoin's volatility.
The first step, what we do is, I alluded to that already, is a classical rebalancing strategy, and that's a pretty easy strategy. Theoretically, everybody can do it by themselves. One has to define some kind of a rebalancing algorithm. I think a little bit in practice, the problem may potentially be that oftentimes people think about doing it, but when it comes to the rebalancing, perhaps they won't do it. Why? Because when should one actually rebalance in times of euphoria? Typically, when for instance the Bitcoin price is going ballistic, and during this kind of period, you've got great news flow regarding Bitcoin. Everything looks positive, right? So I'm not sure. It's easier said than done, right? In practice, but one can do it if one does it systematically. It's actually pretty simple. But then on top of that, and I think that's actually as an investor, what we really like is one can use the volatility from the derivatives markets via options. In our case, we have defined an event-based rebalancing when, for instance, 40%, when we reach 40% Bitcoin exposure, we rebalance back to 25%. And when we approach this level, for instance, which is currently again the case, then we can start writing call options at the levels where we can pretty much estimate roughly where the rebalancing is going to happen. We don't know it exactly because it also depends on the price of gold. But most of the rebalancing price levels is determined by Bitcoin's volatility. So we can roughly say at what price levels we are going to have to rebalance, and we can write call options at these strikes. So at these price levels, and that gives us this big advantage that we can receive premiums by writing call options, basically giving us cash flow, and the same we can do on the lower boundary. So if Bitcoin is underperforming and we are starting to going to rebalance at 10 percentage points exposure, we can start writing put options, which then basically again allows us to collect premium. And I think that's actually really an interesting feature of this approach, because the one thing what every investor criticizes about gold, and to some extent also Bitcoin, but not so much in that case, is that it has no yield, right? It doesn't pay any interest, doesn't pay any dividend. And that's also where you guys come in, where your business model also comes in and helps investors out potentially to solve this problem, right? But this is perhaps a little bit different approach to kind of enhance gold's performance with yield, with some yield. by combining it with Bitcoin and writing options on top of it. So that was, I think, quite an interesting creation, and we've been doing this for almost 5 years now in the first strategy, and it's going pretty well. So we've got actually that's, I think, the benchmark which we are looking at is risk adjusted returns. So obviously, the absolute returns is not a good comparison, but we've been beating gold and Bitcoin's risk-adjusted returns, and that's actually also the case we made ex ante, and so far we've been achieving that.
There's about $15 trillion worth of physical gold in the world sitting there costing money rather than being used. Is just absolutely insane. Monetary Metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's cumbersome, it's not particularly easy to ship, and it costs money to store in a protected manner. This platform Monetary Metals created is a proven concept and allows gold to be put to productive use. So instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
Yeah, I find it such a ingenious method, which is, hey, Bitcoin is volatile. That's kind of the nature of the beast. Yeah, again, we can have a theoretical argument. Well, what if everyone's using Bitcoin at Starbucks? Okay, yeah, maybe it'll be less volatile, yada, yada, yada. But in the real world, in reality, Bitcoin is incredibly volatile, but that doesn't necessarily have to be a bad thing. You can use that with this rebalancing strategy plus writing options contracts to actually provide you cash flow from Bitcoin's volatility. It's a really interesting technique. And like you mentioned, what we do at Monetary Metals, we provide investors in gold ways to earn a yield on that gold paid in more ounces. So start the year with 100 ounces. You can end the year with, for example, 103 ounces. And that's not through options contracts. That's not through a dollar-based writing contract. That's actually through a gold-denominated fixed income return. So if you're interested in that, you can check out monetary-metals.com for more. So Mark, now so you're kind of an expert in this field, if you want to call it, alternative assets, sometimes alternative currencies, gold, Bitcoin. So I want to ask you, you're a bit older than I am. I'm obviously a bit younger than you are. It seems like younger investors are really interested in the crypto space. Older investors, not so much. And then on the vice versa, older investors really understand gold. They have it sometimes in their portfolio. They pass it down to their grandchildren. But the grandkids get the gold and they're like, what do I do with this? So my question is, who do you think is going to acquiesce first? Who do you think is going to kind of go to the other side of the line, if you will? You think that the boomers are going to say, okay, it's time to figure out how this Bitcoin thing works, and all right, grandkids, you got to teach me about the digital wallet? Or do you think it's going to go the other way around, where these people who are very tech savvy, understand cryptocurrency, understand this new form of technology, go, maybe there is an actual use case to gold?
That is a very interesting question. I mean, I definitely can confirm what you said regarding the demographic demarcation line. I don't know where that exactly goes. Perhaps when it comes to digital natives, that's obviously the generation where you're more prone to digital assets, and boomers, which are more in the analog sphere. I may be just somewhere in between that, so I can remember a world without cell phones and the internet, but I had it already in my late teenage years. So yeah, I think I can relate to both worlds. I think what is oftentimes perhaps overseen, especially when one perhaps follows heated debates in social media or so regarding these two asset classes. It is, I think, also a function of the amount of wealth you are talking about, right? So when you talk about, say, not significant wealth, not a generational amount of wealth, I think, and that's typically obviously the younger generation, which didn't have time yet to accumulate the wealth, right? I mean, for them, a high risk asset actually suits pretty well when in terms of their lifespan and in terms of their investment horizon. When it comes to older people, they don't want to take too much risks typically, right? So they want to preserve their wealth if they have a significant amount of it. So I think that's a factor also, and one can see that when for instance, and I know cases of that, younger people become crypto millionaires or whatever, they start to get interested in other asset classes, and they start at some point they typically do start to diversify out of Bitcoin, for instance. So I mean, you've got super maxis who would never sell their Bitcoin probably, or at least they talk about never selling their Bitcoin. But again, once it comes to, I always say every Bitcoiner has his price. At some point, you really think about, okay, this is so much wealth now. Perhaps I should do something else with a part of it at least. That was, by the way, also a little bit the evolution when I actually had my personal tiny Bitcoin allocation in the beginning, and it became significant in my terms for my private portfolio. I really started to think about, okay, now this is not gambling money anymore. This is serious money now. What should I do with that? And I started diversifying out into gold. That was actually that sparked the idea of having a strategy which does this systematically. So I think this is perhaps the evolution when it comes to the younger generation. When they come to more wealth, they will think about other assets which aren't so volatile, and vice versa. Well, older generation, in my experience, again, when they start to be a little bit open, I mean, it is like the phenomenon of digitalization in general, I think has become more and more clear to also to the older generation, increasingly with the increasing features. You know, I mean, it's not directly connected, but take ChatGPT for example. You know, that's really a digital application which also elderly people perhaps can use if they're still, you know, in the internet and so on, and all the other stuff which is going on, and also older people, I think, realize more and more that the digital sphere is not going away and becoming more and more important for society. So when they come to that conclusion, I think it's not a huge leap anymore for them to imagine that one also needs some exposure perhaps to digital world, to this digitalization in their portfolio, right? And even though if they may not like be mentally flexible to go into all the details, because it is really a intellectual challenge. So, but just the realization of the increasing importance of the digital world may lead them again to allocate a part into Bitcoin. I think that would be a typical journey in both sides.
A question for you. So when gold ETFs came out, they changed gold investing. It used to be you have to go down to a physical coin shop or bullion dealer and buy physical gold. Now you can just go on your Robinhood app or whatever and buy through your brokerage account a gold ETF. So Bitcoin also has an ETF. Obviously, both of these ETFs have influenced the assets, you know, market prices or the market caps. Which do you think has a bigger influence? Do you think the ETF in Bitcoin has unlocked more of that market cap, or do you think the ETF in gold had a bigger influence? Because like you're mentioning, for a lot of people, understanding what a cold storage wallet is, I mean, you might as well juggle chainsaws because it's just never going to happen. But An ETF, almost everyone can understand that. Almost everyone can go on a brokerage account and say, buy me some of this. So where do you see that kind of ETF status helping more, gold or Bitcoin?
Very good question. You are correct when you say the gold ETF changed a lot. I mean, when one looks at the numbers, I think in the gold ETFs combined, I don't know, I have the exact number on the top of my head, but it's roughly 3,000 tons, which are invested in gold ETFs. Compared it to the total gold stock of 200,000, 20,000 tons roughly. That's not even 1.5% or so. So it's not huge. But one has to relativize this. A big chunk of this total gold stock is not investable gold. It's somewhere in jewelry, in art, and so on and so forth. It's not liquid. It can be made liquid if the price is high enough, but it's not liquid as of today. But just take for matter of comparison, let's stick to the 1.5% rough number, which is in gold ETFs. When it comes to Bitcoin, currently close to 20 million Bitcoins are around, and Bitcoin ETF just surpassed the 1 million coin mark after not even 1 year in existence, which relates to over 5 percentage points of Bitcoin's stock, right? So if you take these two numbers, obviously Bitcoin ETF was hugely successful and arguably has more impact also on the price. Again, also here one can perhaps relativize the total stock, because part of the stock has been lost, and even though Bitcoin per se is liquid, but there may be some wallets which aren't accessible so fast. So one can also make the argument that not all of the Bitcoin stock is either available or liquid, right? But again, just to stick to these numbers, which we roughly know, and then you can see Bitcoin ETFs have a bigger impact. But I think what is interesting about this question is one part. Leads to one factor which I've been stressing all along, because one of the fundamental differences between Bitcoin and gold, obviously, is Bitcoin is quote unquote only a monetary metal, and that can be seen as a positive, but that has also a negative and I think this is when it comes to the volatility side, also the reason why Bitcoin will never never will evolve to a low volatility asset, or definitely will never approach gold's volatility, because the fact that gold not only has industrial use cases, but also I'd call it secondary store of value use cases like jewelry and so on, especially in emerging markets and so on. You have a lot of counter-cyclical elements in the gold price. I give you a specific example. India, traditionally a huge consumer of gold or holder of gold. And if the gold price falls, Indians buy more gold. They always act counter-cyclically. If it rises too fast, they buy less. They basically buy as much as they can afford. You can determine it by GDP and FX rates and gold rate. And this is a very counter-cyclical element, which helps obviously dampen the volatility. And also on the supply side, if the gold price rises, people dig into their into the closets and see if they find some golden teeth from whenever, and bring it to the smelter, right? And this in aggregate helps the scrap gold, helps the gold demand supply if prices rises high. So coming back to your ETF question, so if one thinks about it like that, Bitcoin is only a monetary metal, and for that matter, it is also makes sense that that something like an ETF will be even more dominant in the Bitcoin space, which is great on the upside, obviously, if you have a stampede into this asset class. But, and I've been warning people all along, and I expect the higher basically this allocation becomes of ETF holders, the higher the potential is for a high drawdown. Because think of it, who holds ETFs, traditional portfolios, institutional investors, and we have a debt-based monetary system which is prone to deflationary shocks from time to time. And if we should enter a liquidity crisis in a time where, like, perhaps Bitcoin holders already hold, I don't know, 10 percentage points of the total supply or even more, and they all press at the sell button at the same time because they have to, be warned. There are no Indians coming to pick up this huge additional supply, right? So this is, I think, something which one needs to keep in mind.
That is a really fascinating point. And the way I might try to think about that is, there is only monetary demand for Bitcoin. Gold has other uses. My dad is a dentist. He will use gold. If it becomes super cheap, he'll buy some more. If it becomes, shoots the moon, as they say, and goes to $5 million an ounce, he's going to be ripping gold out of my teeth. So, hopefully the gold price doesn't rise and my teeth remain intact. But Bitcoin doesn't have that stabilizing feature. And it's a really interesting point that you make. And now I want to touch on this, which is liquidity, right? So people are talking about, oh, Bitcoin is incredibly liquid. And gold is also incredibly liquid. But what they forget about the Bitcoin people, because they're kind of new to this, they might have never seen a deflationary shock in their investment horizon, is that in, let's say, a recession or a depression or a sharp market downturn, gold is actually one of the first assets to get sold off because, like you said, it's incredibly liquid. And if you need to sell, right, oh, I'll never sell my gold, I'll never sell my Bitcoin. If you need to sell because you're an institution or an individual that has rules-based system on their portfolio, you get called up, hey, you need to sell something, you might be selling the most liquid asset you have. It's not going to be your house. It's not going to be, your grandma's china. It's going to be your liquid stocks or your liquid ETFs. And if Bitcoin, a large percentage of the total Bitcoin is in an ETF format, those are all sold because they're a highly liquid asset, which is good. They're sold because of their liquidity. That can have a massive shock on the Bitcoin price because, again, there's no dentists who are pulling Bitcoin out of teeth. So for Bitcoin holders, that's something to think about on the downside as well as on the upside. So let's talk about that jewelry demand and how it affects price stability in gold. Do you weigh industrial demand differently than you do something like a monetary asset? And how do you try to price Bitcoin? Do you use a fundamental pricing strategy? Do you use sentiment? What are you using to try to price this asset that seemingly only has a monetary demand?
Yeah, that's an extremely difficult question. I mean, one probably needs to have some kind of knowledge, or at least one needs to have the monetary perspective on when it comes to the premises that Bitcoin's price should rise at all. Because why should the price of Bitcoin rise? Well, okay, the adaptation may keep increasing. It has been increasing significantly, and which at the end of the day means if it keeps increasing and more people use it as store of value, perhaps at the end of the day it will become some kind of a unit of account, which, by the way, then could solve the volatility problem. When everybody denominates everything theoretically in Bitcoin, volatility is gone, just as gold's volatility was gone pre-1971, right? There was no volatility in gold because gold was the unit of account via the dollar, but it was. And so that the argument, just as a side note, the argument that Bitcoin can never become money as such because it's so volatile in my view, is false. Just to also make that clear. But it's a difficult. It's quite difficult to imagine how we can actually get there to that it becomes a unit of account. But keep that aside for a while. When if one doesn't have the premise that the monetary, I'd say the monetary status of Bitcoin will increase over time, then it probably doesn't really make sense to invest a lot of it, or to invest any of your wealth in there. One needs to at least, I think, have a small percentage point, attribute a small percentage point of probability to this kind of scenario. But it actually doesn't have to be that big, the percentage which one attributes to this outcome, because if this happens, the outcome is huge. So and then going back to your initial question, how to evaluate Bitcoin. Well, I'd say you've got two main functions: the store of value and potentially unit of account, or before that being a currency, right? So then probably the comparison makes sense with gold, like with the overall market cap of gold. That's I think something a lot of people look at also. Gold market cap is, I think, roughly at $18 trillion currently. So these 220,000 tons of gold, if you value them with market price, you get somewhere at 17-18 billion. Bitcoin is, I don't know, close to a trillion, I'm sorry, and Bitcoin is close to 2 trillion. So what we look at is we have just like percentage points in market cap. And we touched 10 percentage points last bull market 2021. We haven't been approaching. We are close to 10% again today. 2 trillion versus close to 20, close to 2 versus close to 20. So all Bitcoin currently worth 10% of gold market cap. So one thought could be how much, when it comes to store of value, how big will be the role of Bitcoin as a store of value vehicle relative to gold? I mean, very extremely bullish scenarios for that, maybe Bitcoin will become worth as much as gold. So parity, sorry. Which currently would imply 10x of the price. But then you don't take into account what will the gold market do. I mean, we are very bullish on gold as well. We have our long-term price target at the end of the decade at $4,800 roughly. If you take that price again, and then you have a market cap of 38 trillion, I think, in the gold space. And then again, you get to much higher numbers, right? So it really depends on the assessment of how big will be the role of Bitcoin as a store of value, I think. And then on top of that, one can perhaps attribute some kind of additional probability if it perhaps becomes even more important in terms of currency. I think of that as a kind of an additional optionality, which personally I don't price in, because I think valuing it compared to gold is good enough and is conservative enough, actually. And if something more than that happens, that's great for investors, but we don't have to factor that in today.
Another question for you. So obviously you've done a couple of strategies where you pair Bitcoin being volatile with gold being more stable. Have you ever considered silver as a Bitcoin alternative in a portfolio? And what should investors think about if they own gold, if they own silver? Is there really a point in adding Bitcoin to put more volatility into their portfolio, or is the volatility that comes with silver enough?
We use silver also in our portfolios, also to actually enhance a little bit our premium returns, or our income by writing options. And again, in this case, we think about it really strictly as a portfolio manager. And what I think the analysis shows is that you can actually add 10 to 20% silver to your gold portfolio, and you don't increase your risk significantly, right? But you can enhance a little bit your returns. But it, as gold and silver are pretty highly correlated, one really doesn't have huge amounts of diversification effects. A little bit different is the story when one talks about Bitcoin, gold, and silver, because especially Bitcoin versus the precious metals has very low, surprisingly low correlation, actually. Currently, actually, it's been pretty negative. So if one price rises, the other price falls, and vice versa, which gives you a lot of diversification and helps to reduce your overall volatility, which is typically welcome by investors. So one can use silver in our view to actually optimize your portfolio a little bit more. But when one uses gold already, one can't go overboard because silver has similar characteristics as gold.
So how do you weigh something like inflation or deflation risk when choosing between gold and Bitcoin? Gold has a really storied history. It's been through inflation, it's been through deflation, it's been through depression, it's been through recession, it's been through high stock markets, it's been through low stock markets. Gold has seen everything the humans have done basically since forever. Bitcoin, although has had these incredible rallies, it really hasn't seen all different types of markets. So when you're thinking about risks like inflation or geopolitics, how are you thinking about allocating between gold and Bitcoin? Or do you say, I'm just going to be agnostic completely and let the portfolio do the talking?
In our strategy, we're pretty agnostic. So we really have defined these allocations and we're sticking to them. But if one wants to think about it, I think, which is also interesting, starting with gold, as you rightly pointed out, that has the longest track record and so on. It is quite a difficult piece to grasp if is gold an inflation hedge or not. And I think it depends on various factors. Are you looking at price inflation? Or are you looking at monetary inflation? What kind of time horizons are you looking at? I think it's pretty clear. The longer time horizon you look at, the better the inflation gold gets as inflation hedge, right? So this is, I think, often overseen in the conversation when people try to want to play down gold's role as inflation hedge. If they point to any given year, see, there was no correlation to the price inflation. But then again, if you take the very long term track record, I think it's quite evident that gold has been a great inflation hedge over the years, over the centuries, actually. But when it comes a little bit to the more shorter term time horizon, which is also interesting, and I think that's also part of the confusion. I think it depends what kind of inflation, especially also what kind of deflation we are talking about, right? For instance, look at the 1930s, Great Depression, where you had the deflation, especially 29 and 30 to 33. As I already mentioned, we're living in a debt-based currency system, right? And it was partly debt-based back then also already. When you take about when you take into consideration credit, bank credit. If one really has a debt deflation, right? If like, for instance, a banking crisis, or also take 2008 for that matter, you really have the situation that the monetary supply is contracting, right? Which is, I think, the classical definition of deflation, monetary deflation, which leads to price deflation, right? As a consequence of that. And at first, if prices perhaps fall slowly only, that's not a good environment for gold. But if you have this debt deflation taking overhand, and everybody talks about, is their money still safe at the bank account, right? Then counterparty risk becomes a topic. So during an environment of quite severe deflation, currently suddenly gold perhaps becomes really interesting, because now the counterparty factor is relevant, right? But if you talk about like a smooth deflation, which is perhaps like during the classical gold standard, happening during the gold standard, that's actually not a bad thing. It's actually a very good thing. Prices fall slowly. Then you don't have this counterparty problem, and that you don't have this systemic problem. And I think one really has to distinguish these two worlds. Are we talking about an environment of a debt-based currency, or are we talking about the positive deflation, which is brought upon due to innovation and value creation?
Yeah, it's a great point. If TVs become cheaper because we have innovation, why that should affect the price of gold is unclear.
Right.
But if all of a sudden people are selling their stocks because there's panic in the streets, okay, then you could see why that type of deflation, if you want to call it, is potentially good for the price of gold. Another question here. So we used to have these kind of simple financial rules of thumb, 60-40 portfolio, or the 4% drawdown rule. How do you see those changing now that we have currencies like Bitcoin or gold that produces a yield? Do you think that those kind of rules of thumb are still going to be useful going forward for investors, or is it time that we get new rules of thumb?
We talked specifically about the 60-40 portfolio in our latest in Gold We Trust report, and we actually presented a new interpretation of the new 60-40 portfolio, which we defined as being a combination of productive assets being or yield bearing assets like stocks and bonds, like what's the classic 60-40 portfolio, in combination with hard assets, with gold and Bitcoin, but also commodity. So what we proposed there was having perhaps 60% in the traditional productive assets, in a combination of equities and somewhat bonds, not so much. 45% equities and 15% bonds make up the 60 portfolio part of the new 60-40% portfolio. And the 40% we divide up into security gold, because we like to distinguish security gold, which is really physically and no counterparty risk and so on. 10 percentage points performance gold. That may be something like monetary metals, where you have some yield, or it may also be some kind of a part of mining stocks and so on. It's like a little bit of a derivative on the gold price. 10 percentage points in commodities, and 5 percentage points in Bitcoin. That was our 60-40 portfolio, where you have really a significant chunk of non-inflatable assets, as we like to call them, relative to income bearing assets.
Mark, you have such an interesting take on portfolio construction. You really have a unique mind when it comes to thinking about assets, constructing a portfolio, and just the monetary system in general. So I want to ask you our second to last question here, which is, what's something you would like me to ask all of the future guests who come on to the Gold Exchange podcast?
Wow. Well, I've been seeing a few of your podcasts, which I found very interesting, and you've got very interesting guests. So I think perhaps challenge them about Bitcoin. Why not? I like to do the same thing with gold investors and with Bitcoin investors. Bitcoin investors are always challenged about gold, right? So I think the discussion is good and fruitful to some extent. Challenge them about Bitcoin.
A golden exchange. Mark, it has been a wonderful time speaking with you. Where can people find more of your work?
Our homepage is incrementum.li. You can find our In Gold We Trust report on the homepage. We also have some monthly or quarterly newsletters, the Gold Compass, Bitcoin Compass, which are chart books, which are actually well received around the world. You can have them free of charge, delivered into your email, and looking forward to subscriptions. And on Twitter, Mark Valek, my handle, I can be found there as well.
Mark, I'm so excited to have you as part of the advisory board, and it was a great time. We'll look forward to speaking to you again.
Thank you, Ben. It was a pleasure. Have a great day.
This episode was brought to you by Monetary Metals. Monetary Metals is a different kind of gold company. Others buy and sell gold. Monetary Metals operates the Gold Yield Marketplace, a platform of products that offer a yield on gold paid in gold to investors and institutions, and are gold financing simplified, reliable financing denominated in gold with a built-in hedge for gold-using and gold-producing businesses. To learn more, visit www.monetary-metals.com. See you next time.